Hi there, welcome to my YouTube channel. So, I've been talking about the risks in investment. So today I thought I will talk, the, what is risky and what is rewarding. So how much of risky and how much of rewarding investments should you go for? So you would know typically, as a thumb rule, it is inversely proportional. So the more the riskier, it is actually positively proportional. So the more the riskier, more the rewarding that can happen. And the less the riskier, less the rewarding. So essentially, if you risk more and you're lucky, you would probably be rewarded more. But I'm using the word lucky here slightly loosely, but if you take risk and take it with ample amount of research, I think you will be rewarded. And normally that's what happens, unless, of course, there are outliers and there are exceptions. So today I'm going to talk about a little bit of that and some aspects that I think you should be mindful of. So before we jump in, as usual, please like my videos, please subscribe to my channel, please comment on my videos so that I know what exactly you're looking at and I can then craft out a video based on what you're looking at. Please smash that notification bell so that you know every time I upload a new video, and also share my videos with people who you think would benefit from my research, from my knowledge, and from my videos. So without further ado, let's dive in. Before we start, let me talk about my ebook. So this particular ebook is on my journey as an entrepreneur. It's titled Six Figure Corporate Job to Master Entrepreneur. In this ebook, I've spoken about the time back in 2010 when I quit my six-figure globetrotting corporate job. So I've spoken about the preparation that I took to dive into this journey of an entrepreneur, the challenges I faced, and how I overcame those challenges. Now, I'm very sure a lot of you are looking to becoming an entrepreneur. So, with that in mind, I've put down 3 worksheets in this book where you can answer certain questions and get points, and you will know towards the end how much where you stand in terms of your preparedness as an entrepreneur. I've also scored myself based on my mindset back in 2010. So you would know how much I scored. And you would also know that I have 2 companies today, one in Singapore, the other one in India, and representations in the US markets. So you would know how successful I am. The greatest thing about this ebook is that it's available to you for free of charge. It's available on my website. The URL is flashing on the screen. I'll put down the URL in the description box below. Click on it, go to the page, put down a name and email address, and the link to download the ebook will be emailed to your inbox. I hope you like the ebook. Do give me your honest feedback. Now let's talk about the risk versus rewarding investment. So the concept of risk and reward. So risk reward is a general trade-off underlying nearly anything from which a return can be generated. This is very true. Anytime you invest money into something, there is a risk, whether large or small, that you might not get your money back, that the investment may fail. So, of course, those are the uncertainties. For bearing that risk, you expect a return that compensates your potential losses. In theory, the higher the risk, the more you should receive for holding the investment, and lower the risk, the less you should receive on average. Let's now, so this is a repeat. So let's now talk about how to determine risk preference. So with so many different types of investments to choose from, how does an investor determine how much risk they can handle? Every individual is different, and it's hard to create a steadfast model applicable to everyone. But here are 2 important things you should consider when deciding how much risk to take. So I'm going to list down 2 points. Time horizon. Before you make any investment, you should always determine the amount of time you have to keep your money invested. The riskier an investment is, the greater its volatility or price fluctuations. So if your time horizon is relatively short, you may be forced to sell your securities at a significant loss. So if, for example, let's say you invest, $100,000 and it's only for 5 or 6 months, but suddenly you need to pay off certain debts or you need to buy a property and you need that money. So obviously the time horizon was short, and hence when you take back that money, so when you sell the securities or whatever investments you have, you might incur losses. Whereas if you know that you're putting $100,000, let's say your kid is very small and you look keeping that money for his or her education, let's say 10 years later, 20 years later, you know for sure that you will make money over that period of time. So with a longer time horizon, investors have more time to recoup any possible losses and are therefore theoretically more tolerant to higher risks. The second point is bankroll, determining the amount of money you can stand to lose to other important factor in figuring out your risk tolerance. This might not be the most optimistic method of investing, however, it is the most realistic. By investing only money that you can afford to lose or afford to have tied up for some period of time, you won't be pressurized to sell off any investment because of panic or liquidity issues. The more money you have, the more risk you'll be able to take. So basically, let's say you're using your bottommost dollar to invest. I would tell you not to because that's dangerous. So in these times of pandemic, I think this is very, very critical because a lot of people are losing their jobs. A lot of people have their hand to mouth in terms of their monies in the bank account, and that could be a challenge. So you should not venture into investment uh, with that kind of money, the last money that you have. Now, what's investment risk pyramid approach? So that's what we is critical. See, after deciding how much money is acceptable in your portfolio to acknowledging your time horizon and bankroll, you can use the investment pyramid approach for balancing your assets. This pyramid can be thought of as an asset allocation tool that investors can use to diversify their portfolio investments according to the risk profile of each security. The pyramid representing the investor's portfolio has three distinct tiers. I'm going to talk about the three tiers. Now, this is the pyramid. I've taken this from Investopedia. So these are the three pyramids. So you have a base, you have a middle layer, and you have a summit. And that's how your low risk to high risk goes up. So let's talk about the base first, the base of the pyramid. The foundation of the pyramid represents the strongest portion, which supports everything above it. This area should consist of investments that are low in risk and have foreseeable returns. It is the largest area and comprises the bulk of your assets. So you must be careful about this government bonds and any other instrument where there is 100% security of your investment that you would definitely get back the money. Those are the investments that you should look at here. Now let's look at the middle tier. This area should be made up of medium risk investments that offer a stable return while still allowing for capital appreciation. Although riskier than the assets creating the base, these investments should still be relatively safe. So real estate is a great example. Equity mutual funds, great examples. Now, so why real estate? Because you could purchase a property and you could rent it out. So you would have a stable return every month. At the same time, the property price will also appreciate. So there's a capital appreciation. So now, of course, there are market-driven situations where it may not it may crash, and all those questions may come up. But then it's still a little more riskier than the base, but it is still stable and still relatively safe. Now, the most critical and which is the most unstable or more riskier investments are the summit, reserved specifically for high risk investment. This is the smallest area of the pyramid portfolio and should consist of money you can lose without any serious repercussions. So it should not be the bottom money that you have, the last dollar that you have. Furthermore, money in the summit should be fairly disposable, so you don't have to sell prematurely. In those instances, like I said, when there is a capital loss or when you have the least money in your pocket, so those should be the smallest in the pyramid. So options, futures. So basically, where you're taking you're gambling. Those are the I'm not saying gambling. I'm not saying that you should go to the casino and gamble. I'm saying when you invest in options and futures, these are essentially you putting in money. There is a fair amount of gamble there. I'm not saying that it's entirely a 100% gamble kind of investment, but yes, if you do proper research, you will still make money there as well, and good money, because there's higher risk and higher returns, higher rewards. So to summarize, you must look at the pyramid. You must allocate your investments or investment proportions should be based on the pyramid, three tiers of the pyramid. Base must have the maximum. Middle tier would have slightly more than that, and the top tier, where there's highest risk, should always have the least amount of investment, which you could potentially even write off if there is a massive loss. So that's what I had to share today. I urge all of you guys to go through this pyramid. You can do your own financial calculations. You don't need to reach out to an expert, but if you do, you could reach out to me. I could help you on that. I would also direct you to the video that I did yesterday about risk and how you would what kind of risks are there. How would you do your calculations on beta and how could you arrive at those figures so that you could do your calculations and your monies are safe, and then use those calculations and those investment calculations and use the pyramid for those kind of calculations as well. So I would direct you to that video. I'll put the link to that video on the card above, but take a look at it. I'm 100% sure it'll be useful to you. So, well, thank you very much. Thank you for listening to me. As you know, my name is Saurav Mukherjee. I'm a digital and technology marketing leader with over 20 years of global experience. I'll put down my LinkedIn URL in the description box below. Click on it, go to my profile page. If you like my profile page, feel free to send me an invite on LinkedIn. Also, I regularly work with clients where I try and solve their business, marketing, technological, and investment challenges. If you're looking to engage in me as your consultant in your company, you could drop me a line on LinkedIn, or you could write to me on the contact page of my website. I'll put down the contact page, the link to the contact page of my website in the description box below. Then we can have a conversation and see how I can help you guys. So finally, before I go, one more request. Please like my videos. Please subscribe to my channel. Please smash that notification bell. Please comment on my videos, and please share my videos. So until next time, stay safe and stay healthy, and I shall see you soon. Bye-bye.